Get ready to go back, well, almost 30 years. The rest of this year, or maybe for the next little while, we're going to hear a whole lot about 1995 and 1996 without maybe the Seinfeld or Friends references to make it fun. We're going to hear about 95 and 96 because rate cuts are coming to central banks. Whether they admit it today or not, more and more the evidence is coming in that shows the economy is incredibly weak, and not just in the US, but around the rest of the world. And it's not getting better. So, in that situation where disinflation becomes more and more of a certainty, central banks are going to pivot toward that weakness. Of course, they're not going to call it weakness. What they're going to do is instead say, this is just a little bit of insurance. Like Alan Greenspan gave us allegedly in 1995 and 1996. If you aren't familiar with the 94 bond massacre and the rapid series of rate hikes engineered by Greenspan, that started in January of 1994, bringing the federal funds target rate from 3% to 6% in what was then a very rapid rate hike regime. Now, as the economy started to show signs of a little bit of softness, Greenspan rapidly pivoted in July of 1995 with a rate cut, followed by two more, one in December of 95 and then January and February 1996. I think it was February 1996. So three rate cuts total. And of course, not many people remember this episode because there was no recession. So in Federal Reserve lore, Alan Greenspan engineered a soft landing. Though there are, of course, any number of questions about whether or not there was actually any recession danger to begin with. But it doesn't matter. We're talking about the Federal Reserve. We're talking about central banks, which means narratives. That's what we're going to hear. We're going to hear 1995 over and over again as the economy goes weaker and weaker and weaker, and central banks try to pivot without creating any panic. Steve Van Meter. You remember 1995? That was a pretty good year, I think, not just in the economy, but in overall in general. That's what's going to happen. Jay Powell is going to talk like he's Alan Greenspan, and we're going to get a couple rate cuts, and it's not a big deal, just a little bit of insurance to make sure everything goes smoothly.
You know, Jeff, I do remember 1995. It was the year after I graduated high school. The economy was a little slow, but, overall it was good. There were still jobs out there. It just wasn't really as robust. And then what really happened afterwards, and I think this is what we're hearing from, of course, the major investment banks right now, is this is the beginning of the next big tech bubble in AI. The stock market is just going to go outright bonkers for the next 20 years because, in a sense, this is looking like a repeat of the mid-90s. And then what happened after that? We got that soft landing. And then next thing you know, those magical rate cuts worked. And then the economy just roared. And so you think about, are we in the same situation as the 1990s? Well, I don't think so at all.
Yeah, what today looks anything like the 1990s. I'm talking about, macroeconomic circumstances outside the United States as well as inside the US. The US was booming at the time. Yeah, I had a little bit of a slowdown in 95, which is why there's an argument about whether or not there was actually any real recession risk at that time. Certainly the bond market wasn't seeing it. There was only a tiny inversion, and only for a couple days back then. And then the bond market everything's fine. And of course, again, everybody remembers the 90s because it was a legitimately booming period. And many people have gone backwards and thought, well, how did it become legitimately booming? Those like Ben Bernanke and economists have said, well, maybe the Fed did it. Maybe the Fed manipulating the federal funds target is one of the primary reasons we had such a prolonged boom in the 1990s. I see you laughing, Steve, because it is that absurd. Again, correlation is not causation, but the Fed has depended upon these correlations for a very long period of time. And Mr. Powell, and he kind of hinted at this at his congressional testimony this week, Mr. Powell is going to definitely lean on these narratives going forward because I believe he knows the economy's in at least questionable shape, if not as weak as it seemed to be with the most recent payroll reports.
But Jeff, maybe that's all the economy needs is a few rate cuts. Because again, you go back right to the mid 90s, we throttled it down. Then all of a sudden you get some rate cuts and it took off. So maybe Powell's just replaying that book, hoping the same outcome's going to happen, except he just says, look, I'm going to slam on the brakes as hard as I can. We're going to just bring this economy right down just as it's heading above target. And then watch, I'm going to pull off. And this engine, it's just primed to go. And it's just going to take off on a nice, smooth trajectory higher here. I mean, look, there's a reason it could happen. But when we start looking at the payroll reports today, I know you've got some reasons for us to say, look, this isn't even a possibility right now.
Yeah, we look around at all of these various signals, not just one or two, but a big number of signals that suggest it may already be too late. The idea that we're still heading into a slowdown and there's still time to rescue the situation, assuming the Fed could actually do that, assuming that the rate cuts actually worked as advertised, it may already be too late to apply them anyway. So the Fed's going to be retroactively cutting rates because the situation appears to be far weaker than most people appreciate. And as you mentioned, Steve, we got three really solid signals in the payroll report. Of course, not from the payrolls themselves, which were just a complete, utter mess and a joke, but from the household survey. We've got three solid recession signals. One is the 6-month average change in the household survey, which turned negative. That only happens in recession, with the one exception being 1995. So there's that one. But we also got another signal, which is full-time jobs on a 6-month basis. That one was absolutely solidly negative, which is 100% recession. And the third signal, one statistic that many people actually pay attention to, the unemployment rate. Even though the unemployment rate is low at 3.9%, over the last 10 months up to and including February, it's up 0.5%. And a 0.5% rise in the unemployment rate is a very solid recession signal. So we've got three very solid recession signals from the household survey. You better believe that they know this at the Federal Reserve.
Yeah, Jeff, and the household survey is likely starting to pick up some of these big corporate layoffs because, if I lose my job and I'm on severance and I have to fill out a survey, well, that I'm going to respond that I'm unemployed. That would make sense.
But
But when
Steve,
we
Steve,
look,
Steve, 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 no. It's not an initial jobless claim, so it didn't happen.
right, exactly. Well, I'm going there. I'm getting there because, right, what happens is when my severance runs out, maybe in 3 months or 6 months, then I am going to file a claim. So you get this weird Goldilocks scenario that you have this made up establishment survey number. And I'm jokingly saying that because we've been seeing these heavily revised downward numbers. In fact, last month was revised down by a third. I mean, how do you get a statistical variation that big? It just doesn't make any sense. But the household survey seems to be picking up what we've been seeing in the news, saying major companies going to lay off, a few percent here and another few percent over there. It just wasn't showing up. It's showing up now in the household survey. But again, you come back, as you said, to the initial claims data, even the continuing claims data, you say, well, it's not terrible. In fact, the initial claims looks really good. Continuing claims not so great, but why aren't these showing up? The only matter of question is when they do show up, and it's going to be a big number because a household survey is telling us it's a warning sign that something's wrong.
It's not the only signal either, right? I mean, because we've got plenty of market signals recently that there is a fair amount of distress that is really building, a clear, consistent deterioration in economic and financial circumstances. Just to go back to the household survey for a real quick second, as you know, that the issue with the household survey is always it's very noisy on a month-to-month basis. And we don't usually see wild swings from huge positives to huge negatives, but it can change on a month-to-month basis. But what we're seeing and what you're saying here is that the household survey has been consistent over a long enough period of time that we say this definitely looks like a recession, because it's not just a 1 month fluctuation or 2 or 3 months. Now we're talking about 6 months, or with the unemployment rate, we're talking about 10 months. There is definitely something going on, which we know. We've talked about this all the time. Businesses are indeed making adjustments in their costs. They're cutting back hours. And then now it appears like they're definitely laying people off too. We already know that they've stopped hiring. We hear that in stories and anecdotes. We see it in data too. And so overall, we get this increasingly consistent picture where more and more of the evidence continues to move in that direction, which is toward recession, not toward soft landing, not toward no landing. And that's going to be something that Jay Powell is going to try to address. as soon as he thinks he's out of the danger zone and 100% out of the danger zone with consumer prices.
Yeah, and absolutely, Jeff. In defense of Fed Chair Powell here, he's got to claim victory. I mean, he has no choice. I mean, if there's like a 2 to 3 months window where he has to go out and just pound the sand to say, look, I did it. I did it. I am the greatest Fed chairman ever alive. Well, this is when you do it. And then maybe people believe in that. And if they do, perhaps they go out and spend. And maybe these people on the household survey that lost their job find another one. It is possible. It just doesn't look like it's likely to happen because we continue to see the JOLT survey, which of course is maybe short of now the non-farm payroll report, one of the most inaccurate surveys you can even imagine because virtually no one responds to the thing. So now you have an issue that employers are scaling down the number of job openings. We see average hourly earnings continue to decelerate, which is a good indicator because as an employer, if you don't feel pressure from your employees that you need to give them higher income, then you're not. In fact, you're going to cut their hours, slow down their wage growth, and lay some of them off. Everything's just kind of slowly trending down. And that's something, Jeff, as you know, people have a problem. They're like, why doesn't this thing just fall over and collapse? Well, it's slow at first, and then it's all at once. And we're still in that slow at first phase here.
Let's talk about some of the market signals that have come up recently, too, because some of them are sending very strong signals about what might be happening here. At least the risks. One of them is gold. Gold has been having a really good period, not just in the short run here to an all-time high, but over the last year and a half, really going back to October 2022. And I know a lot of people think of gold as an inflation hedge, and it's not really that. It's actually an error or safety hedge. And that's one that has looked like more and more people are getting more and more nervous. And part of that could be about the U.S. economy heading into recession, which I think, there's enough gravity there. There's enough critical mass that the recession signals are being triggered that depending upon a gold hedge would make a whole lot of sense here. But also we have to think about the rest of the world too. Europe that's already in recession, which looks to be getting worse. The ECB just came out with new forecasts, which said, 2024 is going to look like 2023, which is not a good thing there. China, of course, we know there's all sorts of financial as well as monetary issues going on in China that we're seeing. So gold is another signal that is moving consistent with what we think the direction the economy is heading to.
Yeah, absolutely, Jeff, because you look around the world. I mean, the German manufacturing sector, every time they get a little bit of good data and they finally say that was the bottom, then the next month is like, oh no, well, we were really wrong about that. Maybe this is the bottom. And now it's starting to pull the Eurozone down, which is exactly what you'd expect. As you mentioned, China, the stimulus is having virtually no effect at all. I mean, none. I mean, and if you talk about stimulus, what's Germany proposing? 7 billion? I mean, that's nothing. That's not even not even going to work. So you look around the world and you say, is there a case that the U.S. economy somehow is in this kind of 1995 maybe soft landing scenario? There's some catalyst that's going to pull it out. Now, maybe there is, and we just can't see it. But looking around the world, we're certainly giving no hope that we can't look and say, well, you know what, China's really recovering here, or Asia, Europe is doing something and that's going to help. We're seeing just the opposite. We're almost seeing kind of, the U.S. at the tail end here, and it looks like we're going to get drugged down following everyone else.
You mentioned China, and that's another one that we really don't want to pay attention to. We got another signal from the Chinese just recently as well. Just this week, the 10-year government bond, the central government bond, the yield on the central government bond fell to its lowest since 2002. And not only that, the big trend in buyers here is the banking system in China. And the Chinese government, to try to explain or really obfuscate what's happening in the government bond market there, big downdraft in yields really since over the last couple of months, they sent out a survey, or they actually sent out a report to Western media telling them about a survey they sent out to the banking system to make them fill out a whole bunch of boxes and information to make sure that the banks aren't participating in this massive bond bubble. That's how they're trying to explain the big downturn in interest rates here, which seems to be accelerating on the downside in the face of, as you were just saying, Steve, all this rescue and stimulus on the monetary side and on the fiscal side. And banks literally aren't buying it. They're not buying the stimulus because they are literally buying safety and liquidity in government bonds.
And Jeff, that is a great point because if someone might be watching saying, well, what does it matter that the banks are buying bonds? Well, you think about what you want your bank to do, and that's lend. So if you're the Chinese government, or we could just put in any government, because this is going to happen across every major industrialized economy going forward, is you put out some stimulus, you're putting out the word, we want to see the economy grow. Well, what do you need your banks to do? Well, you need them to lend. And then you look over your banks like, why the heck are you buying government bonds? Because if they're buying bonds, it means they're not lending. As they're not lending, it means they think the risk are too high, that they need the safety and protection of those bonds because they believe that delinquencies are going to continue to accelerate, the defaults, insolvencies, whatever it is in their books that they're seeing that the government can't see, they're actually worried about it. And that's why they want to buy bonds. So this is not a good sign from the Chinese economy in terms of vote of confidence behind Beijing's move, or that there's any indication that there's going to be a turnaround in their economy anytime soon.
So, Steve, what you're saying is that if interest rates go down, that's not a good thing?
Yes, yes, I know that's hard for a lot of people to believe, Jeff, and we joke about that all the time. But right, and that was something we saw, with Powell. Interest rates, he got out in front of Congress, and interest rates started to dip down. And even today, after the non-farm payroll report, the initial reaction is they went down. And kind of why would that happen with a big payroll number? Because the bond market's suggesting here that maybe things aren't that good, and that's what we're seeing in China, seeing that around the world. Just a matter of my opinion before we don't just see a few rate cuts, before we see a lot of them, and from every central banker.
Yeah, and rate cuts are not like 1995. I mean, 1995, let's be honest, that meant nothing. Greenspan was just doing stuff to do stuff. Rate cuts didn't help, certainly in 2001, where he cut rates by an aggressive series of rate cuts, and we got the recession anyway. The most you could say is that, well, that helped limit the downside of the recession, which is a nonsense argument, too. Certainly, rate cuts didn't help in 2007 and 2008. Again, you're best trying to argue that it helped keep the recession from being even worse than it was when it was the worst recession this side of the Great Depression. So the idea that rate cuts are going to somehow save us, just kind of ridiculous here. But the point we're trying to make here is that interest rates have been moving lower and aggressively since last fall. And here comes some of the data, not just on China, not just in Japan or around the world. Here comes data in the US labor market that is starting to look like what interest rates have been telling us all along. Government bonds, all about safety and liquidity. Well, gold is about at least just safety, and gold has had a record run here too. Check out what that's all about at the video link below. As always, I thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.